Interest on reserve balances. To encourage banks to either increase or decrease their cash reserves. Remember, if they have a larger cash reserve, they're going to be more apt to loan money out because they're borrowing it at a lower rate. The Fed pays a risk-free overnight interest rate called the interest on reserve balances, the IORB. Okay? Since the Fed does control the IORB rates, it can use this rate to incentivize banks to either lend more money to other banks or keep more money in reserves, right? If the Fed wants to stimulate growth, it can reduce the rate paid on reserve balances. Because if a bank is making more money on the reserves, they're less apt to then loan the money out because they're gaining interest on that, right? They're making money on that. If the Fed lowers that amount, they're not making as much. So it's up to the bank to then figure out what they want to do with the reserves and they begin to loan it out, right? In response, banks will lend more money to each other and to consumers, reducing mortgage rates. See how this all kind of correlates now? If the Fed wants to slow economic growth, it can increase the rate, making it more attractive for banks to boost their reserves and earn risk-free interest from the Fed. When this happens, mortgage rates usually rise. Supply and demand. See how much control the Fed actually has?